Good afternoon, everyone, and welcome to this live webcast on international investing. My name's Mitchell Sneddon. I'm the Head of Portfolio Services here at InvestSMART, and today, believe it or not, we're going to be going through international investing, why you're probably underweight international equities, and what you can do to actually look to improve that and rectify that in your personal portfolio. Just a couple of quick easy hints on how to do that. Now, this presentation is something that I presented as a part of our regional roadshow series. We started off going down to Wollongong, Nowra, Bowral and Canberra. So thank you for everyone there who came out and met us and got to see these presentations. Now, I won't be doing the broader national roadshows in Sydney, Brisbane and Melbourne, so hence why we're doing this presentation here now as a live webcast. So before we do get into it, I don't actually have the disclaimer slide, but we'll be putting that up at the end. But just keep in mind that this is general information in its nature. It's not to be taken as any personal or specific advice. Also, as we're going along today, you'll be able to ask questions in the question box just below the video, and I can see a few people have already taken advantage of that. So do type in any questions as we're going along. I will get to them at the end of my formal part of the presentation, and then we will jump into those. So anything that pops up as we're having a chat here, get your questions through, and I'll try to take care of all of them if time permits. So part of my job for the last 8 years or so has been talking to investors and talking to a lot of people who run self-managed super funds or people who are just getting out, starting out investing. And one thing that comes up time and time again is people are underweight international equities and underweight international exposure. Now, it's very common. So my first slide here is about why people don't have it. You might not have the knowledge to buy direct equities, to go and set up a broking account and fill out your W8 Ben forms for investing in US stocks. You might not want to pay fees to the manager of a fund to manage a portfolio for you. You might not know what regions to buy when it comes to international investing. Where should you start? Asia, US, Europe, etc. And then of course you've got currency concerns. So not just Australia dollar to US dollar, but of course all variety of currencies if you're looking across Asia and Europe as well. So there's some major sticking points with people about not having that international exposure. But I think there might be one other reason as well that people are underweight international equities, and I think this could be probably the main reason. I think it's this guy on your screen now. With the introduction of franking credits, imputation credits into our system here. So those franking credits are incredibly valuable to Australian investors, and of course the international markets don't actually pay franking credits. So these are really, especially for a lot of people in self-managed super funds who live off the dividends, etc., these franking credits are highly valuable, and people know they should probably diversify away from Australia, but they're heavily reliant on the franking credits and the dividends that are coming their way. So I believe that Mr. Keating here played a major role in people being not as diversified as they probably should. And so as well, I think franking credits have potentially handcuffed the Australian market's growth. Why I say that is because there's such a thirst for dividends that a lot of companies will have a higher payout ratio than a lot of their international peers, and what that does is, of course, it leaves them without a lot of capital to reinvest back into their companies to look to grow them. And so what we try to do here at InvestSMART and the Intelligent Investor and Eureka Report is we try to talk to people about looking for total return and not just yield. So that for us is really important. If you get 6% in capital growth or 6% in a grossed up dividend, you've still got 6% in your hand. you can eat capital growth as well as income. So moving on to our next slide here, and here's another reason why I think international investing is important for people. So this slide shows a breakdown of the ASX 200 sector by sector. Of course, financials make up close to 40% of our market. Then you've got materials. So basically, you can almost list the ASX 200 on one hand. You know, you've got a couple of banks, you've got a supermarket, you've got a telco, and you've got a couple of resource companies. So that almost kind of sums up the Australian market. So we're not overly diversified there because we're very top heavy in financials and resources. If I skip now ahead to the next slide, and it compares our market to the US. So, and it's important to remember this, that on the previous slide, information technology only made up 2% of the Australian market. Here in the US, of course, it makes up 23%, and no points for guessing who those individual companies are. You've got, of course, Google and Facebook, Amazon, etc., that are in that category. So not only does diversification give you regional diversification into international equities, but it also diversifies you away from being overly exposed to certain specific sectors. So that's another point, another reason why I believe diversifying away from just Australia is important, and why investors should be looking at it. Now, the other reason you can see here on this chart, and look, I've been really cheeky here and just stolen a screenshot from ComSec. You can see the growth. The blue line on this chart is the US market, the S&P 500, and the yellow line is ourselves. Now, this is just share price return, and you can see that we've been left behind completely. And that's because the US market is made up of some significantly dynamic companies, much more so than what Australia has produced recently. I can't foresee us producing a Facebook, a Google, or an Amazon anytime soon. And that's really propelled the US market to, not just recover from the GFC, but very, very significantly recover and outperform us. Now, let's talk about how I can bang on about why you're underweight and what the benefits of getting that international exposure are. But I mean, if you just look, for example, at our international equities portfolio, we just use exchange traded funds there, and over the last 12 months it's returned a 20% return. So that's just an instant benefit of diversifying there. And talking about exchange traded funds, they're one way that you can easily go out there and get exposure to international markets. Now, how they work, they're basically index tracking. For those who are unaware of an exchange traded fund, they will set out to track a very specific index, be it the S&P 500, for example, or the ASX 200. There are a number of different indices out there. Some are of individual fund managers' own creation by building a certain specific set of rules. Now, these are very similar to a managed fund. Basically, it's one bucket of capital. You fill out your application form, so to speak, by clicking on the buy button on your online broker, and you fill out your redemption form, so to speak, by clicking sell on that button. And then, of course, behind the scenes, there's a certain level of liquidity, and if you get a run if a lot of money's coming in, you'll see market makers in the background are there, and they're creating units and they're selling them to those investors that are coming in on board. And as they're creating those units and selling them, they're getting that capital and they're investing in the underlying securities of the exchange traded fund. On the inverse of that, when there's a lot of people choosing to sell, they're having to sell down stock, of course, to meet these, and then they're actually buying back the units from the investors. So that's how the actual mechanics of an exchange traded fund works. So looking at the pros and cons of using ETFs for international exposure, one, they're really easy. You can go to the InvestSMART section website. Under the research section, we've now got a specific field where you can filter ETFs by anything that you want, and exposure is one of those. So you can actually just hit a drop-down list, click international exposure, and get the entire suite of exchange-traded funds that invest globally that are available on our Australian market. So they're really easy. You get instant diversification. So for example, I go out and buy the S&P 500. I'm buying all 500 companies within the S&P index. Now, these can be incredibly low cost, and we're going to go and have a look at a few of them in a second here. And for example, the iShares S&P 500 ETF, IVV is the stock code, that has a management expense ratio of 0.04%. You will never, ever, ever find, probably in my lifetime, a managed fund with a management expense ratio of 0.04%. That's because running these portfolios, these exchange-traded funds, there's fixed costs associated with them. So as the size of the funds in the portfolio grows, then those fixed costs become lesser expense as a percentage of the total assets under management. Now the cons, you will always outperform the index that you're tracking by the cost of the fees, and there could be some tracking error as well. And then you'll hold the good, the bad, and the ugly. Now, where we believe we're experts in-house here at InvestSMART, we believe we're experts at handpicking Australian equities with our Intelligent Investor Analyst team. We know the market, we know it well, and we have outperformed consistently there. On the inverse of that, looking at international equities, that's not our bread and butter. So what we try to do there is just get broad-based exposure to those markets because we don't have the confidence or the ability in-house to go out there and handpick individual companies to outperform. So when we're doing that, we're literally holding thousands of companies. And so just because something's big and in an index doesn't mean it's actually any good. It could be downright terrible, in fact. But you don't have that choice when you're investing in exchange-traded funds. You're getting absolutely everything. Now, on to the next slide. So basically what I want to cover off here is how you at home can just use our information to go out there and do it all yourself, to get real simple, easy diversification straight away. And that's through using these exchange-traded funds and using the InvestSMART exchange-traded funds little section under the research tab. Now, what to consider when buying these? So we put together an international equities portfolio using ETFs. What have we specifically looked for? Well, we focus on fees and size. So we want to go for the biggest and the cheapest when we're tracking a very, very standard index like the S&P 500. So just a clue for what's coming up, we do invest in the iShares S&P 500 ETF because you can't really beat 0.04% as a management expense ratio. We are wary though of tracking error, and we've got a score system that evaluates all the exchange traded funds based on the fees, the size, the tracking error, etc. It's out of 5 stars. And the tracking error, how that can occur, well, because underneath the actual scenes, you do have people that are having to buy, or algorithms buying and selling the stocks on market to keep up with inflows and outflows from the exchange traded fund. Also, a lot of exchange traded funds will have like set distribution periods. They might be quarterly or twice a year, and that's to distribute any dividends that they get paid. Now, all these stocks pay dividends at different times of the year. Of course, if you pay a dividend and it's not within, say, the quarterly distribution period or the semi-annual distribution period, it's going to sit as cash within that portfolio. So that creates cash drag, which can deviate the exchange traded fund from the underlying index. So that's something that we do monitor, the tracking error of the actual exchange traded fund compared to its index. And then for us, I'd say be mindful of smart beta exchange traded funds. Smart beta, we typically look to avoid these in most cases, but smart beta is where it's not actually tracking a traditional index, it's tracking an index of a manager's own creation. So there's lots of different ones out there, but basically they've got a predefined set of rules that off those set of rules they create an index, and then those the ETF will buy those stocks within that index. So we're just mindful of those. For us, if we're going to take a passive investment approach and use an exchange traded fund to get exposure to an index, we just want that raw exposure to that particular index. We believe that investing and hand-picking individual stocks is much more of an art form than a science, and so hence why we do avoid that. So moving on to the next slide here, and how you can actually build after we're done here. The market's still open till 4 o'clock, so you can even go and do it this afternoon. How you can go and build your own exchange traded fund international exposure portfolio. Basically, you need to start off with your benchmark. What are you going to use as a benchmark to say this is the amount of US equities I should have, this is the amount of Europe I should have, this is the right amount of Asian equities I should have. An easy one to use is the MSCI All World X Australia. The X means excluding. So of course you probably manage your own portfolio of Australian equities at home. You don't need to be doubling up with Australian exposure, even though Australia only makes up 2% of the global market. So set an appropriate benchmark. For us, I'd say the MSCI All World X Australia is fine. Now, once you've done that, you need to find the specific exchange traded funds that operate in those regions that will give you that exposure to those regions. And then, of course, find the lowest cost producer, the lowest cost, the biggest size, the lowest tracking error, etc. So the InvestSMART exchange traded fund star system will really help you identify the best exchange traded funds to use when you're putting together your portfolio. The next slide here actually shows you the breakdown of the MSCI All World X Australia. Basically, there's 60% of it is the US, 16% of it is other. That means the other 22 developed markets of the world just combined there. 4% is Germany, another 4% is France, the UK and Japan at 7 and 9% respectively there. So this can be your initial starting point, your benchmark as to setting up your portfolio. So write down your dollar value that you're looking to invest as a total in international markets, and then work out what 60% of that is, work out what 9% of it is, 7%, 4%, and 16%. And then you know the dollar value that you'll be able to invest across these different markets. Now what we need to do is actually handpick the individual exchange traded funds to get us this exposure. So starting with Asian exposure here, basically we use one of these in our international equities portfolio. It's very difficult to get broad-based Asian exposure in Australian ETFs. iShares pretty much has the market, as you can see on this particular slide. And there's slightly higher management expense ratios here as well. So when you're investing in less developed markets, the costs will be more typically. Now, there's a lot of region-specific ETFs in here. We have not specifically chosen to go China or Japan or Hong Kong. The one that we use internally is the iShares Asian 50 ETF. Basically, think of what you're buying into there. You've got things like Baidu and Tencent. That's China's version of Google and Facebook. You then have a little phone manufacturer in Korea called Samsung as well. I think they're your top 3 holdings within that portfolio there. So you're investing in the 50 largest companies in all of Asia. So that's what that particular portfolio will hold. So if that's the exposure that you want, then that's the one, our particular selection here. No points really for guessing here which one we specifically use. I've already mentioned it. It's the iShares S&P 500. Once again, if we go off the biggest and the cheapest, well, at 0.4% and 2.3 billion of funds under management within that specific ETF, you can't really go too much past that. I will note for those people who do invest in the SPDR S&P 500, it doesn't have 20 million of funds under management. It's got a lot more than that. It's got quite a few billion, but on the domestic one here in Australia, it's approximately 20 million. The rest are in there, in one that's domiciled in the US. So iShares S&P 500, if you are building out your portfolio to match that MSCI All World ex-Australia, you'd have 60% of the portfolio invested in that particular ETF. So the European ETFs here, we don't have too many options here in Australia, but there could be some points for guessing here. We don't specifically have the largest ETF in our particular portfolio, but we do have the cheapest. So we've gone for a bit of a compromise there, and we've gone with the Vanguard European ETF, which the code there is VEQ. So this makes up our European exposure, and that's broad across all the European countries, and gives us that exposure to the likes of, say, France, Germany, etc., that were in that pie chart before. So this, and you can then go into, say, the Vanguard website, or in the InvestSMART website as well, and you can go to that specific ETF, and it'll tell you the breakdown of the regions that it's invested in, and you should see the likes of the UK, France, and Germany are sitting quite high as a percentage within this particular portfolio. Now, the last one here I have is how do we take care of that other basket? The way that we've specifically chosen to do it is actually to use the Vanguard All World ex-US exchange traded fund. It's the cheapest, it's one of the biggest there, and so basically when we exclude the US, that takes up that 60% of the developed markets. This will actually pump up everything else and give us a broad diversified exposure there. So that's what we use instead for getting that other category covered. So my next slide here is about calculating your own management expense ratio. And the reason why I put this in here is because you could go out there and buy all these ETFs. You could say subscribe to InvestSMART, and if you're an InvestSMART subscriber, hopefully you know that you have total access to view all of our model portfolios at any point in time. So you can actually right now go to the research tab, go to model portfolios, and look at all of our diversified portfolios and intelligent investor portfolios, and can see the exact stocks that are in them and the exact weighting. So you could actually pay a subscription. You could see the ETFs that we use, and you can see when we change those ETFs, and you can go out and you can buy them specifically to the weighting that we have. But so what you need to keep in mind there when I say calculate your own management expense ratio, keep in mind your transaction costs, the underlying cost of the ETFs from the management expense ratios, and then of course your subscription costs and whatnot if you are using us to build a portfolio and to track and manage the portfolio. If there will come a certain dollar value where it makes sense for you to do it yourself. So over a certain dollar value, that subscription cost and the brokerage costs and everything are minimal, and you're better off doing this yourself if you have the time, the will, and the inclination to do it. Then on the other hand, those costs relative to what you're actually, the dollar value that you're investing, you might be better off going into a product, say, like our InvestSMART International Equities portfolio, and because it will actually work out cheaper for you to do that rather than to have a subscription, pay all that brokerage, and manage it yourself and track it yourself. So you got to just weigh up those costs. We want people to be able to do it themselves, but where it makes sense for them not to on a financial level, then we're happy for them to invest in our ready-made international equities portfolio. So you just got to keep that in mind. Always keep your costs in mind when you're managing your own portfolio. Now, finally, my last slide here is just showing you our international equities portfolio. I talked through all of these. You can see we've got the iShares Asian 50, we've got the iShares S&P 500, we've got the Vanguard European Shares ETF, the Vanguard All World ex-US. Now this one I didn't speak about, but it's the UMAX, which is the Beta Shares Yield S&P 500 Yield Maximizer Fund. What this particular fund does, and yes it is smart beta, is it produces additional income. So a lot of people don't invest internationally because the yield's not there for them. Well, the guys at Beta Shares have tried to get away around that, and what they do here is they hold the S&P 500 in this ETF, then they write covered call options over those 500 stocks. What that essentially does is it produces additional income for the portfolio, so it'll have a higher payout ratio than the standard S&P 500. But the side effect of that is it will cap the upside potential of that portfolio as well. So you should expect to see this particular portfolio outperform in a flat and a sideways and negative market compared to the S&P 500. But when we're in a bull market and that S&P 500 is charging along, this portfolio will, because it's taking that yield off the top, will actually underperform. So we do have it in here just to increase our US exposure and to aid us in getting a little bit of extra yield. It doesn't, at the end of the day in this particular portfolio, it doesn't add that much to the yield, but every little bit helps. So now that I've just gone through our formal part of this presentation, what I'll be jumping into now is the questions, and I haven't seen them coming through, so I've got no idea what's sitting there. But we'll take a quick look now, and I'll see if I can do my best to answer any questions that you might have here. So I might just refresh my display here, and we'll get to these questions. So this is just, Michael came in nice and early asking, how do I get exposure to the US market? I hope I've answered that in this presentation here. We specifically use the iShares S&P 500, IVV is the stock code, but we also use the UMAX, which is the Beta Shares S&P 500 Yield Maximizer. So depending on your particular circumstances and what you're trying to achieve, you could use one of those to get that exposure. Fred says, our super fund has 20% direct in international resource companies and about 10% in international managed funds. How much more should we have, and with what country/regional exposure? Fred, I'm going to roll into my disclaimer again. I can't give any personal specific advice. What I can tell you to do though is, if you haven't done this already, go and use the InvestSMART portfolio manager. What that does is it'll break down your holdings and tell you what's international and what isn't. If you've got some international holdings that are international under the bonnet, but they're listed on the ASX, you might have to go into your holdings section of the portfolio manager, click the little cog, that's the settings for each individual stock, and then when you're in there, go to asset class mapping. So what that'll allow you to do is, even though it's where our system's saying that it's ASX equities, you will be able to change that and override it and put it as international equities, and that way you'll get a clearer indication of where your exposure sits. And then you can see exactly how much you've got compared to what your goal setting says you should have. So put your assets in there, set your goal, and then check your assets against the ideal scenario that our goal setting calculator is showing you, and then you know where your exposures lie, and then you know how you can actually go about getting some more international exposure if you need it. So I hope that's helped there, Fred. Now let me see here. There's a Deepak asks, do you know of stake.com.au? No, I don't. Sorry, I've not heard of them before, but there you go. Joe asks, John Addis wrote some time ago, and this is a long question, so bear with me, how to gain international exposure through ASX listed companies. The likes of, say, BHP, CSL, Nanosonics, Woodside, Computershare. These are companies that generate a lot of revenue offshore. What's a sensible way to evaluate that exposure as part of your overall portfolio that also includes international managed funds? InvestSMART's portfolio manager cannot account for it. You're very much correct there. So you would just have to keep that in mind. Once again, you could, depending on the percentage of their revenue that they earn overseas, you might want to switch it 100% to international equities using the asset class mapping feature in the portfolio manager. Additionally, and of course, well, a lot of these, even though some of them, like a lot of them, earn their revenue offshore. Of course, they're listed on the Australian market. If our market does take a tumble, especially those in larger companies that are in the major indices, then they're probably going to get hit too with our Australian market. So just keep that in mind. Joe, for you, I would say take advantage of understand how much revenue these companies generate from their international dealings, and then apply that using the asset class mapping section, so you can get a clearer indication of where your exposures sit. Tony says, any reason you would not use the emerging markets, IEM, emerging markets, rather than the all world ex-US, saves doubling up on the euro holdings? That is a good question, Tony. The emerging markets, basically when we're following the MSCI, in that particular example that I mentioned, the MSCI All World ex-Australian benchmark, it covers the 22 of the 23 developed markets around the world, and so that doesn't include a lot of these emerging markets, and so that's why we don't have a pure emerging markets ETF within the particular portfolio. But for those who are wanting to get exposure to emerging markets, that ETF is a good one. And of course, you can always use the InvestSMART under the research tab, the InvestSMART ETF filter, so you can actually specifically look for emerging markets ETFs. Fred asks, what about the timing of getting particularly US exposure now? The graph you just showed us is impressive US growth, but we are at a risk of buying at the top of what might later be seen as a historic peak. Good question. We get the question on timing a lot. We don't try and time markets here at InvestSMART or Intelligent Investor. That's not what we do. Timing markets and making big macroeconomic calls is fraught with danger, is incredibly difficult to do. It's not something that we consider ourselves experts at, and even the experts get it probably wrong more times than they get it right. So whenever I'm looking at an investment for myself, I'm looking to invest now for the next 5, 6, 7, 8, 10, 12 plus years. And if you're going into equity markets, because you're in a higher risk asset class, you should be going in there with a 5-year plus kind of outlook for that particular exposure that you're getting. And for that, I would say that looking back now, if say we invested now in 5 years time, I'm not trying to time the market. I know I'm going to get this broad exposure, and over that time period, probably going to get the average return of, say, the S&P 500, for example. So we don't advocate market timing. We don't advocate making big macroeconomic calls that affect your portfolio. What a lot of people would do, if other people might do, is if you believe the S&P 500 is overvalued now, keeping in mind it could stay overvalued for a very long period of time, for years. If you believed it was, you could look to drip feed or dollar cost average into these particular ETFs or anything that you're looking at. And if you do think that a correction is imminent, then you can maybe have a little bit in there now, a little bit later on, a little bit later on after that, and just get that average price. There's nothing you can really do in the long term to avoid corrections, and we're not advocating market timing. We're advocating long-term investing. Now let me see here. It looks like we're pretty much out of questions here and out of time. So I'll look to call it a day there. Now, if you do have any questions that you haven't got to send through, please send them to me directly. My email address is m.sneddon, that's Sneddon, just like Billy Sneddon, the Prime Minister. Opposition leader. So m.sneddon at investsmart.com.au. You'll be able to reach me there, and you'll be able to send through any questions that you have. If you want to take a look at our portfolios or get me to walk you through the portfolio manager, and also to see where to find all of our model portfolios so you can track them and follow along and do it yourself at home, then please get in touch with me, and I'm happy to pick up the phone and walk you through that. But for now, thank you everyone for joining me, and we'll catch you next time on another live InvestSMART webcast. Thank you.